Welcome to our conversation on preparation of the balance sheet, income statement and cash flow statement. So in the previous session we saw with the opening balance sheet, we prepared the balance sheet of the year 1 end, income statement for year 1 and cash flow statement for year 1. Now we'll see for the same business year 2 transaction. So therefore, at the beginning of this year 2, you have the balance sheet of the company with the cash, stock, assets and some corresponding sources. So there is a stock of 70,000 and they sold the entire stock for 80,000. And they sold the stock on credit and they collected money of 50% from the old debtors. Old debtors is 84,000. So the collection from the old debtors is 50% of it. So therefore the business received 50% of the old debtors and the current sales is fully on credit. So therefore the closing debtors for the end of year 2 is opening plus the credit sales minus the collection. Okay. Salaries for the year is 30 and the corresponding, sorry for that, and the corresponding COGS is 70,000. The corresponding COGS, entire stock was sold, and if entire stock is sold, so there will be no more stock available, so it becomes 0. Okay, it becomes 0. And after that there is a salary of 35,000. Here I would like to bring to your notice, in year 1 also there was salary, but by mistake we did not enter the salary. We will not change the year 1 income statement, balance sheet and cash flow now. We'll see that after completing year 2's exercise. So for the timing, ignore this, but I've highlighted it so that you can examine it a bit later. So salaries for this period is 35,000. Okay, 35,000. And nothing is mentioned, so let us assume that we paid the salary. So salary 35,000 is an expense and salary 35,000 is a payment, so therefore there is no liability. Payment to the old creditors 20%, so there is an old creditors of 390,000, so the creditors paid to the extent of 30% and 30% of 390, so therefore the old creditors will reduce to the extent of the amount paid to them. So the old creditors will be now reducing by 78, so the creditors will be 312,000. Interest paid along with the first year's interest. So interest paid, every year we have to pay interest of 24,000. So we'll show the interest as an expense. However, there was an interest payable of the last year of 24,000. So interest paid in the current year is equal to 48,000. Why? Because 24,000 of the last period and 24,000 of the current period. But observe here, amount paid is 48,000, but expense is 24,000. With the balance 24,000 has gone towards the payment of the last year's interest. So as a result, there will be no more interest payable on the balance sheet because the entire amount has been paid in the current year. Similarly, if you see the rent per month as usual is 2,000. So per year rent is equal to 24,000. But how much did we pay the rent? Payment towards rent is equal to 28,000. So why did we pay more? the company paid more of 4,000 because there was a rent payable of the previous time period. As a result, rent payable becomes zero. So rent payable has become zero because you paid in the current period. You see this. Interest payable has become zero because interest has been fully paid in the current and the previous year because we have sufficient cash sitting with us. And during the period, there is no other expense. So therefore, the total expenses is equal to 153,000. And PBT in this period, there is a loss. There is a loss because there is only inflow, income of 80,000 and expenses of 153,000. So there is a loss of 73,000, and because there is a loss, there is no tax further. So I put it at 0. Okay, so tax is equal to 0. And so profit after tax is equal to same 73,000. Okay, 73,000. Since this year profit is negative, so the retained profit will reduce to the extent of the current profits. Okay, the retained profit will reduce to the extent of the current profit. 150,000 plus negative profit of 73,000. So income statement for year 2 is done. Now let us find cash in hand. Cash in hand is equal to cash available, which is opening cash plus collection. So cash available is equal to 596,400 and cash payments are 189,000, which is the summation of all payments. And cash in hand, therefore, cash available minus the cash payment. So cash available is 407,000. And we know that cash available is a source, is an asset, So the entire cash in hand is transferred to the balance sheet. No change in the capital, no change in the loan because we have not paid that loan or paid back that loan. No change in the shares, we are just holding on to those shares. And so therefore our asset should be equal to the sources. Assets are equal to the sources, and that we know that by the end of the period, any accounting period, A should be equal to the sources. So in this case, in year 1 there was a profit. In year 2 there is a loss. In year 1, because of the profits, the retained profit went up. Whereas in year 2 there is a loss, so the retained profit has gone down. So therefore, it is necessary to observe the financial statements or the performance of a company, not for a particular year, but observe the performance over a period of time. And so that we can understand whether the business is making or is running its operations efficiently or not. But to come back to the small mistake that we did in the it happens in real life business also. Sometimes we forget to enter some transactions. Suppose this salary 72,000 would have been entered as a expense in the year 1. In that case, what would have been the effect? If salary would have been an expense, the profits will come down and cash will go down. So let us see that. So we made that adjustment in this. So I put the salaries now, 72,000, paid the salaries 72,000. So profit before tax, if you see the profit before tax here, profit before tax was 172,000. Profit before tax 172,000 has reduced to 100,000 because of the expense, that is salary, which was not recorded in the previous case has been recorded. So sometime it happens by choice, sometime it happens by chance. So by reducing the expenses, they've inflated the profit. But the moment you make the adjustment, profit has come down. When the profit has come down because of the salary, and assume that the salary has been paid, so therefore cash in hand has come down. So balance sheet will tally provided you have entered the transactions properly. So observe the business transactions, identify the items, and examine the effect on the financial statements is the model that we are following. And don't just see the financial statements for a particular period, but observe over a period of time. So then you will be seeing the changes in the financial statements and understand the impact of the decisions on the financial statements, and then help the business in taking decisions. So in this case, the opening equity in this case, opening equity is equal to capital plus reserves or retained profits. Okay, and capital plus reserves or retained profits, that is 100 plus 60,000. Then it went up to 250, then it has come down to 177,000 because of the losses in the second year. Thank you very much.